Okay, traders, this is Michael Huddleston with the Inner Circle Trader blog entry for January 25th, 2011. We are recapping London session from a cable trade. We have the daily up on our charts right now. Notice that we have a left shoulder, head, right shoulder. Within this large head and shoulders, we have a secondary head and shoulders. We have a left shoulder, head, and right shoulder. So overall, looks very toppy in here. Doesn't mean we can't go higher, but this was the stage we used for looking for a breakdown. If market flow should break down, which we're going to go over in a moment, why we would anticipate a sharply lower price move. Okay, looking at the high, we're going to take a fib and draw from the high down to the low. Price trades up to, and I don't have it on the chart here, but it's just a 79% retracement level. So price did trade up to this level in here. So optimal trade entry for the daily was fulfilled. Okay. Now the reason why I was fishing for a long trade initially last night going into London. Let's pull up our fractals. Okay, let's zoom in just a little bit so we can get a better look. Okay, prior to this steep drop we had last night, the nearest fractal low was at 158.36. So until price broke 158.36, the daily chart's market flow was up. Prior to that swing low, the other one was here. So I mean, we've had a really wide range between the two short-term swing lows or fractal lows that we use to determine market flow. Okay, so let's go and dial down to a 4-hour chart. Okay, looking at a 4-hour chart prior to our precipitous drop off in the London session, the most recent swing low was in here, and it was at 159.20. So until 159.20 was broken to the downside, market flow remained up. When the candle broke 159.20, 4-hour turned south on market flow. Going down to a 1-hour chart before our nesty plunge, we have a fractal low at 159.64. Okay, so until price trades below here, the 1-hour market flow is up. So that's why I was looking for an initial buy, because I was following the market flow, looking for another push above the 160 figure. Okay, let's drop that in. Okay, here we can see that price traded above 160 here, resistance at 160, couldn't get above it here, sold off, and then back up to it again, had some resistance area, sold off one more time, tried to get above it, and right in here, it just, to me, looked like it was going to try to stab up to the 160.15, 160.20 area to blow out essentially any stops that would have been resting above here. So that's why I went long. Looking at some of our other tools in conjunction with this perspective. Okay. We're going to go down to a 15-minute chart. Okay. We've already worked with market flow on the higher time frame, so we're going to remove it on our 15-minute chart. Okay. Now, looking at how price was trading, as soon as we went above here, let's look at the pattern that reversed on us and then dropped off. Let's look at a 5-minute. Okay, this was last night going into London. Now here's the figure, 160 figure. Price traded above it, monkeyed around, flirting with it. And right in here, I noticed that there was a optimal trade entry that unfolded for the downside. We're going to pull a fib. Down in here. Let me see if I can zoom in just a little bit more tight. Hopefully I can. Let me see. Yeah, there we go. Here's the high. And we pull the fib down to a swing low in here. Price trades up to 62% retracement and 79% is in here. So we trade right back into it and then started trading down softer. And that's when I spoke up in the chat room and said, okay, do you see what just unfolded? We have an optimal trade entry. And we traded down, broke through in this area here. Once we gunned this session low in here, I anticipated a pull back to it as resistance. Let's go back to a 5-minute. Okay, we don't need the pivots for right now, so let's take them off. Okay, this was that session low. Let's just drop a line on it. So once we broke through it, we traded back up into it. First time it acting as support here, broken, now becomes resistance. And 159.64 on this candle in here. I sold right into the bullish candle that it was before it became an inverted hammer. And then price traded down here. I basically, once I put the order in, I felt very confident that we had put the daily high in, and I mentioned that in the chat room. Because you're usually going to find that the daily high or low is made within the first 4 hours of trading after New York midnight. So in other words, set your time, no matter where you are in the world, set your time to midnight at New York Eastern Standard Time. If you can determine what time that is wherever you're at in the world, start counting 4 hours from there. So in other words, between midnight and 4 a.m. New York time, you have about a 90% chance that you're going to make the daily high or low within those 4 hours. So price action suggested that we had placed the high in, so I felt very confident taking the loss. It was only 28 pips, and went short in here, and basically didn't want to be involved with commentary because my weakness as a trader would be to talk about the trade while I'm in it, and either I will take the trade off sooner than I really want to, or I'll talk myself right out of the trade. So to avoid all those emotional tug of wars that takes place within me as a trader, I just avoided having anything to do with talking about it. So I just basically told everyone in the chat room, this is where I am. Stop was up in here. So basically, less than 30 pips on both trades. The first one stopped me out with 28 pips negative, and then I went short, and then took 30% off as we slid down here, which covered the first initial trade that I bought long in here that failed, and the remaining 70% I took off at 157.80. So let's talk about how I got those targets, and you can see how we can use some advanced concepts with the Fibonacci. Let's pull up a, here we go, let's get some more data on the screen. Let's grab our fib. Alright, see this high here, this low here. This is an overall swing in the market. So using our fib, okay, generally you see things like that with Fibonacci. Pull a low to a high, and you'll see 0, 23%, 38%, 50, 62, 79 is not in here, but I can visualize it, so I don't need it. And then 100% retracement. That's your standard application of a Fibonacci tool. What I done was I geared mine to show swing projections. Okay, this is why you'll see some folks talk about, well, you really got to do the fib, pulling it from a low to the high, always pulling from left to right. Well, that's fine if you're going to use it like everybody else is using it. If you haven't already learned, I take a lot of the common things that people use as tools, and I flip the script, so to speak. In other words, I use it in an unorthodox way. I will be contrarian in every aspect of it. So this is what I've done. I've set it up where now once we break this low here, I can see where price is going to shoot down to and give me my objectives. Now let's assume for a moment that price really breaks down not only this low here, let's go out one more time frame. Okay, I can take the fib. Now I can also drag it out to this low here. Make sure it's resting on the low. Okay, and you can see how we went down to this level here, nailed it perfectly, bounced on this one, bounced in here, bounced right on this one here, hammer in here, and now we're working within this 2 fib levels here. This is how I use swing projection, and I know you're probably wondering what are these levels and how can you get them to. Okay, so let's go over that real quick. Alright, on your MT4 platform and on your other platforms that you may be trading with through your broker, these are the levels you want to have on your standard zero line: 23.6%, 38.2%, 50%, 61.8%. You want to have the 79% retracement in there. I don't need it because I know I'm looking for 100%. There's your standard. Now we're going to have the 1618. Got to make sure you have it as these numbers here, okay? You want negative 123, negative 162, negative 179. You want 1.719, 2.618, 1.618, 1.382, and you want 2, which will be a standard 200% extension, 1.236, and a 79. Once you have that on your fibs, you will have all these lines. You can also swing it so it's a positive, but I'm not gonna bring that up in here. That'll be something I might teach over the summer. I shouldn't even brought it up because now I'm gonna probably get emails about that now. So I have other things I want to teach in the summertime, but right now, as you can see, we have a lot more things to cover. But I called the price level 157.35 in the chat room when price was trading right here. So that's a pretty long ways down, and I was looking for it to get there before the London close of today. We didn't get to 57.35. The low on the day was, let's see here, 157.50 on this feed here. So a little bit off, but not not too far off to be remarkable for the tools to be able to pull that out. Now, why did I think it was going to be such a huge magnitude of a move? Let's go back to the daily chart. Let's remove all of our lines and such. We'll go back to daily. Okay. Prior to this big, huge range, we saw small range, a hammer, but more importantly, we were on the right side of a potential head and shoulders, and I felt that if we gave up the ghost on the market flow on the 1 hour, that would have been the catalyst to send us down sharply lower. Let's look at another concept that was beneficial in me thinking that the market was going to move sharply lower. As you can see, each one of these open, high, low, close bars, they're not candles. Let me go in a little bit tighter so you can see. The other cycle, not only are we looking for cycle ranges from large ranges to small ranges to large ranges to small ranges. As you can see, we have small ranges, big ranges, small ranges, big ranges, small ranges, big ranges, small range, big range, small range, big range, small range, big range. Now today we're in a small range, so we're setting the stage for explosive volatility again, like we saw here. That's one cycle that takes place in the market that's very generic and can be capitalized on. The other one is monitoring where the close is in relationship to the high and the low. On large range days, we have the open near or at the low of the day, or it could be For instance, here, near or at the high of the day and then closing down. Near or at the high of the day and then closing down near the low. Open is near or at the high of the day and then closes down. Well, that's kind of like in the middle, but you can see it's a down close. Look and study all of your charts, and you'll see that this phenomenon takes place all the time. Now, as markets move higher and as the close gets closer and closer to the high, okay, and we start closing right on the highs like we did here, we're probably very close to a high in the market and expect selling. Okay, so all those factors took place, and was basically the reason why I expected range expansion on the downside. And to blow out any of these stops here, we would have to get down below there, and we had this high in here, this high in here as a potential support level. So that was all reasons for me to expect sharply lower prices today. I'm really trying not to talk about something, but it's really staring me in the face, and I'm just going to do it now. Let me take the separators out of the chart. I think you'll like this. Okay, we are going to take a deeper look into market structure and how we can use it to have kind of more or less like a future view. And for some of you lay guys out there that are new to trading, this might be very fascinating for you. And those that are really students of Fibonacci may be already familiar with this, but if you're not, you might get a kick out of this also. Alright, what is this, guys? I don't expect you to answer because I can't hear, but you should be answering. This is a short-term swing low. We have a low and a low, both being higher than the low. I'm sorry, here, this low here, this low here. So we have a low with two higher lows on both sides of it. Okay? We have a high here, and we have a low here. This high in here, I told you in the previous video that we were unfolding a high before we started the breakdown. Let's look at something that's pretty fascinating. If you take this day here, count this as 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23, 24, 25 days, okay, on the daily chart. Let's take that number, okay, and we're going to multiply that by 1.28. Okay, so we should arrive at 31.25. Always round down, so we arrive at 31. So we counted from low to low. Okay, we arrived at 25. Multiplied by 1.28. Okay, that will give us 31. Now we take the high in between the two lows. Here's the high here. Count forward 31 from there, counting 1 here. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23, 24, 25, 26, 27, 28, 29, 30, 31, guys. You see that right there? 31. That means probably some of you are freaking out right now. You knew that this high was going to unfold as soon as this became a swing low here and started trading up. So in other words, if you were buying long and you're a swing trader, you can reasonably hold on to it for 31 days counted from the high here. So you're going to measure low to low, count the days, multiply by 1.28, find the high between the two lows, count that as day 1, move forward that many bars, and you'll arrive at when the next swing high is going to form. And that is tonight's installment, and I wish you good luck and good trading, guys.